Hey everyone, welcome back to Corporate Decoder. Douglas Emmett Incorporated, or DI, just filed their quarterly report, a 10Q for the period ending the 30th of June 2026. We are seeing some interesting moves in their debt and a mixed bag in their income. Quick note, this is not financial advice. Just my take on public filings for educational purposes. The company is dealing with a lot of refinancing and interest rate shifts, and we need to see if their core business can handle the pressure. Let's dive right into the numbers. As of the 30th of June 2026, Douglas Emmett has total assets of over $9.5 billion. That is up from about $9.3 billion at the end of last year, 2025. Most of this is tied up in their real estate holdings, which are valued at over $13 billion before accounting for depreciation. On the flip side, their liabilities are also substantial. They have over $5.7 billion in secured notes payable, which is up from about $5.5 billion at the end of 2025. This increase is mostly due to new loans taken out for recent acquisitions and refinancing activities. It is a big chunk of debt, and we'll need to watch how they manage it, especially with interest rates. Now let's look at how they are making money. For the first 6 months of 2026, total revenues were just over $507 million. This is a slight increase compared to the same period in 2025, which was around $504 million. Their office rental revenue and tenant recoveries are pretty stable, but multifamily revenues saw a small bump. Digging into the office segment, total office revenues for the first 6 months of 2026 were about $406 million. This is pretty flat compared to the $405 million from the first half of 2025. They did see an increase in parking and other income for their office properties, which is a positive sign, going up to about $63 million from around $59 million. For their multifamily properties, total revenues for the first 6 months of 2026 were almost $101 million, a slight increase from about $99 million in the prior year. This segment seems to be holding steady. When we look at operating expenses, depreciation and amortization is a big number, sitting at about $196 million for the first half of 2026. This is slightly down from nearly $200 million in the same period last year. This decrease is mainly because some of their assets are now fully depreciated. But here is where things get interesting. Interest expense jumped significantly. For the first 6 months of 2026, it was over $132 million, up from about $125 million in the first half of 2025. This increase is largely due to higher borrowing rates from their refinancing activities and the new loan for the acquired office properties. This is a key area to watch as it directly impacts their bottom line. Because of these higher interest costs and other factors, Douglas Emmett reported a net loss attributable to common stockholders of about $5.2 million for the first 6 months of 2026. This is a shift from the net income of over $33 million they reported in the same period of 2025. This is a pretty significant swing. Now, let's talk about funds from operations, or FFO, which is a key metric for real estate investment trusts, or REITs. For the first 6 months of 2026, FFO was about $152 million. This is a slight decrease from about $155 million in the same period last year. The report mentions that this decrease is mainly due to higher interest expenses and lower office occupancy, which were only partly offset by higher tenant recoveries and office parking income. They also report same property net operating income, or NOI. For the first 6 months of 2026, total same property NOI was about $311 million, a small decrease from nearly $314 million in the same period of 2025. The office segment saw a slight dip in NOI, while the multifamily segment showed a small increase. Looking at some specific events, the company acquired a medical office portfolio called the Bedford Collection in April 2026. They also refinanced a couple of large office term loans in May and June of 2026. These moves are aimed at managing their debt and interest rate exposure, but they also come with costs and changes in their financial structure. There is also an ongoing situation with the Landmark Residences, formerly Barrington Plaza. They began moving tenants out in 2023 to do major renovations. While a reconstruction is expected to take years and cost hundreds of millions, the company believes the ruling they are appealing won't significantly change their plans. As always, there are risks. The company points to economic and political developments, competition, and tenant demand, especially with remote work trends impacting office space. Rising interest rates are also a significant concern, as highlighted by their increased interest expenses. They are also exposed to natural disasters, fires, and other property damage, which are always a possibility in their locations. So, what is my take on Douglas Emmett based on this filing? The company is clearly navigating a complex financial environment with rising interest rates and refinancing efforts. While their FFO and same property NOI show slight declines, the core multifamily business seems stable, and they are actively managing their debt through refinancings and interest rate hedges. However, the significant increase in interest expense and the net loss reported are concerning, especially when compared to the prior year's strong performance. The ongoing renovation of the landmark residences is also a major undertaking with long-term implications. They are making strategic acquisitions and managing their debt, but the overall picture is one of cautious navigation in a challenging market. What I am actually looking for is how they will manage their debt load in the coming years, especially as interest rates continue to fluctuate and their current hedges begin to expire. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.